Today we're going to talk about one of the most misunderstood topics in real estate investing: cash out refinancing on a DSCR loan when you haven't owned the property for very long. This is often called the seasoning requirement, and understanding how it actually works can save you months of waiting or help you avoid a mistake that costs you money. Let's start with a definition. Seasoning refers to the minimum amount of time a lender requires you to own a property before you're allowed to refinance it and pull cash out based on its current value. The reason lenders impose this rule is simple. They want to see that the value of the property is real and established, not just a number that was inflated right after purchase. This protects the lender from something called equity stripping, where a property is bought quickly overvalued and then refinanced for more than it's actually worth. Now, here's an important clarification. Most lenders in this market do require some form of seasoning before a cash-out refinance, and a lender who tells you there's no seasoning and no documentation required at all is worth a second look. But a smaller group of specialized programs genuinely do offer no seasoning cash-out, including some that go as high as 80% loan to value when the request is backed by real documentation. Let's cover the strategies one at a time, starting with the most common. The first strategy is called a cost basis cash out, meaning your purchase price plus any documented rehab costs. Many lenders will allow this with no seasoning period at all. The important limitation to understand is that you're capped at your cost basis, not the new, higher appraised value of the property. Most lenders offering this option will also want to see a credit score of around 700. The second strategy is called delayed financing. This applies specifically if you purchase the property with cash, meaning there was no existing loan on it. In this case, you're allowed to refinance immediately and pull out funds up to what you originally paid for the property plus any documented improvements. Just like the first strategy, there's no waiting period involved. You will need to provide proof that the purchase was made in cash, such as bank statements or wire transfer receipts. This is a very useful tool for investors using buy, rehab, rent, refinance, and repeat method. Now let's talk about what happens if you want to go beyond your cost basis. This is when you want to refinance based on the new higher value of the property after your improvements, not just what you spent. This is where the standard seasoning rules typically apply. Most lenders will require 6 months of ownership from the date the property was recorded in your name before they'll allow this type of refinance. Some wholesale lenders will accept as little as 3 months, but they typically limit you to 70% loan to value during that shorter window. If you wait the full 6 months, many lenders will allow you to go up to their maximum of 75% loan to value with no additional restrictions. Credit score requirements for this option are usually in the range of 680 to 700, and you'll likely need to provide photo documentation showing the improvements you made to the property. Let's move into 3 specific lending structures that are worth understanding because each one solves a different problem for different types of investors. The first structure is designed for investors who don't want to be limited by cost basis or by a lower loan-to-value ceiling. This particular lender offers what's essentially unlimited cash out. In exchange for that flexibility, they apply stricter requirements in other areas. Specifically, you'll need to maintain 6 months of reserves in the bank after closing. That means 6 full months of your principal, interest, taxes, insurance, and association dues payments sitting available as a financial cushion. The property also needs to carry a debt service coverage ratio of at least 1.15, meaning the rental income needs to comfortably exceed the mortgage payment, not just cover it. One more detail to keep in mind with this lender: they do not accept a transferred appraisal from a previous loan. You'll need to order a brand new appraisal specifically for this transaction. The second structure takes a different approach to solving the same problem. This lender also offers unlimited cash out, and they allow you to borrow up to 80% loan to value. That's noticeably higher than the 70 to 75% most lenders offer. Naturally, higher leverage means higher risk for the lender, so they offset that risk by charging a slightly higher interest rate compared to a standard 75% loan to value cash out. So the trade-off here is straightforward. You get access to more cash at closing, but you'll pay a bit more in interest over time. The third structure is built specifically for investors who are still inside that 6-month seasoning window, but want to refinance based on the new value of the property rather than their cost basis. This lender takes a documentation-heavy approach. They'll want to see receipts for materials and labor to verify exactly what was spent on the renovation. They'll also request your original photos taken before any work began, along with new photos showing the completed property. Finally, they'll pull your original purchase appraisal and compare it against a brand new appraisal ordered for this refinance. Essentially, this lender is building a complete paper trail to prove that the increase in value is legitimate, rather than relying on assumptions. If you kept thorough documentation throughout your renovation, this option can get you into your equity well before the standard 6-month mark becomes available. If you didn't document the process, this option simply won't be available to you, which is an important lesson for future projects. Always photograph your property before and after renovations and keep every receipt, even if you're not sure yet which lender you'll end up using. So now let's talk about the bottom line. No seasoning cash out at 80% loan to value does exist. It's not the norm, and it's not offered by every lender, but a handful of programs in this market genuinely allow you to refinance with no minimum ownership period and still reach that 80% ceiling, provided you can support the new value with real documentation, like before and after photos and evidence of the rehab work completed. This is exactly why working with a broker who has access to multiple DSCR lenders matters so much. Every lender we've talked about today has its own niche. One prioritizes reserves and a strong debt service coverage ratio. Another prioritizes leverage and accepts a higher rate in exchange. Another builds its entire approval around documentation and proof of your renovation. A smaller group of specialized programs combine no seasoning with that higher 80% ceiling for the right scenario. If you're only talking to one lender, you're only seeing one set of guidelines, and you may be missing the exact program that fits your deal. A broker who works across this space day to day can match your specific situation, your documentation, your credit profile, and your goals to the lender, whose niche actually lines up with what you're trying to do. If you have questions about which strategy fits your specific situation, feel free to reach out and I'll walk you through the details based on how you purchased the property and what your goals are for the refinance.